Two people retire with the exact same $1 million. Same savings, same investments, same spending. Yet over their retirement, one of them hands the IRS tens of thousands of dollars more than the other. Not because one earned more, not because one took more risk, only because of two quiet decisions almost nobody thinks about: which account they spend from first and which investments they kept in which account. It's called withdrawal sequencing and asset location, and it might be the most overlooked tax decision in all of retirement. Let's start with the foundation. In retirement, your money usually lives in three different kinds of accounts, three buckets, and the tax code treats each one completely differently. The first is your taxable bucket, a regular brokerage account. You pay tax along the way on dividends and on gains when you sell, but at the lower capital gains rates. And when you die, those assets get a step up, wiping out the gain for your heirs. The second is your tax-deferred bucket, your traditional 401k or IRA. It grew untaxed for decades, but every dollar you pull out is taxed as ordinary income at your regular rate. And starting at 73, the government forces you to take money out, whether you need it or not. Those are required minimum distributions. The third is your tax-free bucket, your Roth. Qualified withdrawals are completely tax-free, and there are no forced distributions ever. Three buckets, three completely different tax treatments, which means the order you empty them and what you keep inside them can change your lifetime tax bill dramatically. Now here's the conventional advice. The rule of thumb you'll hear almost everywhere. Spend your taxable account first, then your tax-deferred. Save your Roth for last. The logic sounds airtight. Let the tax-advantaged accounts grow as long as possible. And for a lot of people, that order is exactly backwards. Here's why. When you follow that advice, you leave your big traditional IRA untouched for years while it keeps compounding. So by the time you turn 73, it's even larger. And now the required distributions are huge. Picture a $1 million IRA at 73. The first forced withdrawal is the balance divided by 26.5, about $38,000, and it grows every single year after. Stack that on top of your Social Security, and three things happen at once. You can get pushed into a higher tax bracket. More of your Social Security becomes taxable, the tax torpedo, and your Medicare premiums can jump through the income surcharge called IRMAA. The conventional order doesn't avoid the tax. It saves it all up and detonates it in your 70s. So what's the smarter move? Use your low-income years on purpose. There's a window in early retirement, after the paycheck stops, but before Social Security and those required distributions begin. In that window, your taxable income can be very low. That's wasted space if you do nothing with it. Instead, deliberately pull from your traditional IRA during those years, even if you don't need the cash, filling up the low tax brackets. You can take money out or convert it to your Roth at 10 or 12%. Every dollar you move now is a dollar that won't be forced out at 22% or more later, when your income is higher. You're not avoiding the tax. You're choosing to pay it in your cheapest years instead of your most expensive ones, and shrinking that future required distribution time bomb at the same time. Let's put real numbers on it. Say Howard drains about $300,000 from his traditional IRA across his low bracket gap years, taxed at 12%. Under the conventional defer everything order, much of that same money would instead have come out later at 22%. 22 minus 12 is 10 percentage points. On $300,000, that's about $30,000 kept instead of paid. Same accounts, same dollars, different order. Now the second half of this, and it's just as overlooked. It's not only which account you spend first, it's which investments you keep in which account. That's asset location. Think about it this way. Different investments are taxed very differently. Bonds and funds that throw off a lot of interest are taxed every year at your high ordinary income rate. Broad stock index funds are gentle. They pay qualified dividends and long-term gains at the lower rates, and they barely trigger tax until you sell. So here's the principle. Put your tax-inefficient assets, the bonds, the high-income funds, inside your tax-deferred or Roth accounts where their yearly tax disappears. And keep your tax-efficient stock funds in your taxable account, where they enjoy the low rates and get that step up at death. The common mistake is doing the exact opposite, holding bonds in the taxable account, taxed hard every year, while stocks sit in the IRA, quietly turning their future low-taxed gains into high-taxed ordinary income on the way out. Same portfolio, same returns, but one version leaks tax every year and the other doesn't. Put it all together, and a picture emerges. Your three buckets aren't just storage, they're levers. Each year of retirement, you get to choose how much income to pull from each one, filling your low brackets, harvesting gains at 0%, converting to Roth, managing how much of your Social Security gets taxed, steering around the IRMAA cliffs. It's a yearly tax bracket budget, and the buckets are how you fund it. The saver who thinks about this, who spends in the right order and holds the right asset in the right account, can keep tens of thousands of dollars that the equally wealthy saver next door simply hands away. None of it requires earning a higher return. It only requires understanding that where your money sits and the order you touch it are decisions, not afterthoughts. This video is for educational purposes only, not financial, tax, or legal advice. The brackets are 2026 figures, the examples are illustrations, and the right sequence depends on your full situation, including your state and your goals. Talk to a qualified tax advisor or planner before reordering your withdrawals. You spent your whole life deciding how much to save. It turns out the decisions about where to keep it and what to spend first might matter just as much. If this gave you a new way to look at your accounts, subscribe. Every week, we uncover one financial blind spot that can quietly cost or save families thousands, sometimes tens of thousands of dollars, and share it with someone who just retired. The order they spend their money in could be worth a small fortune,